And in our top business story, non-essential goods such as tobacco, beverages and luxury cars will not only be subject to value-added tax, but excise taxes as well. According to financial experts quoted in local reports, purchases of gold jewellery is also expected to invite a 5% VAT, since ornaments will not be considered part of the basic goods category. States across the GCC region have agreed to collect a 5% VAT from January 2018. There have also been plans to impose excise taxes, which could range between 50% and 100% of a product's sale price. An implementation leader at Ernst & Young said that consumers can expect to see significant increases in the prices of certain products that will be subject to both VAT and excise tax, and that the extra fees may discourage some consumers from making unnecessary purchases. So far, only the application of excise tax on tobacco, certain beverages and premium vehicles has been confirmed. His Excellency Obaid Maidataya, the Minister of State for Financial Affairs, has said that an excise duty of up to 100% could be imposed this year on selected items, including tobacco, soda, energy drinks and luxury cars. The Federal National Council has recently passed a draft tax procedure law that effectively lays down the legal framework for the collection of taxes, duties and fines in the country. The excise duty is expected to be issued prior to VAT implementation. DP World's chairman has brushed off concerns about the prospect of increased protectionism damaging global trade, particularly in the US. Speaking on a call to journalists after the company reported its annual results, His Excellency Sultan bin Sulayem said that it was his belief that when the Americans or Donald Trump talk about trade and free trade, he talks about fair trade and is trying to balance trade with other countries, particularly in relation to China. At a Group of 20 meeting over the weekend in Germany, the United States had pushed unsuccessfully for an explicit pledge to ensure trade is fair, but the finance chiefs of the world's largest economies ultimately left out any promise to avoid all forms of protectionism. In a statement yesterday, Mr. bin Sulayem said the DP World expects global trade to remain resilient, even in an era where there is much discussion about protectionism and increasing trade barriers. For the past year, the ports operator said profit attributable to its parent company on a reported basis was $1.13 billion, a 27.6% increase on the $883 million generated in 2015. But this was partly because of the strengthening US dollar. On a like-for-like constant currency basis, profit increased by 6.2%. Similarly, revenue was up by 4.9% to $4.16 billion, but on a like-for-like constant currency basis, the increase was 1.3%. Gross throughput at its ports increased by 3.2% during the year to $63.7 billion, which Mr. bin Sulayem said was ahead of the industry average forecast of 1.3% by analyst Drewry. Fiscal consolidation in the GCC in 2016 will likely lower international bond issuance volumes by $6.4 billion in 2017, while still keeping them at historically high levels. That's according to Moody's Investor Service. The ratings agency forecasts smaller fiscal deficits in all GCC countries in 2017 compared with 2016 and said issuance volumes would remain elevated in 2017 given that governments still need to fund sizable deficits and because, for now at least, market conditions remain favourable. Following record levels of debt issuance on the international market by GCC sovereigns in 2016, Moody's analysts anticipate a decrease in international bond issuance to around $32.5 billion in 2017 from $38.9 billion in 2016. The ratings agency said movements in the oil price and global interest rates, together with factors like the extent of fiscal reform and funding strategies, will determine overall issuance needs as well as the impact on sovereign credit profiles. It argued that increased issuance on international debt markets poses longer-term credit challenges for the GCC. Fiscal expenditures in the UAE are expected to stabilize in 2017, with Abu Dhabi's cuts offset by fiscal expansion in Dubai in preparation for the Expo 2020. Emirates Investment Bank has predicted that economic conditions in the GCC will worsen this year as the risks from oil price volatility, political instability and terrorism prompt high net worth individuals across the region to keep their money in cash or other liquid assets. According to a survey by Emirates Investment Bank, millionaire investors from across the GCC are attempting to protect their wealth through more conservative and cautious investment decisions rather than splashing out on expensive overseas purchases or assets that could be harder to sell in a hurry. The bank interviewed 100 high net worth nationals and expatriates with more than $2 million of investable assets living in Bahrain, Kuwait, Oman, Qatar, Saudi Arabia and the UAE. It found that nearly half of those questioned at 47% felt that the global economic situation was worsening, while just 15% thought that things were getting better. Closer to home, AIB found that high net worth individuals in the GCC have been getting steadily more pessimistic about the local GCC economy. It found that the proportion of respondents who said they felt that economic situation in the GCC was getting worse increased this year to 44%, up from 36% last year and just 9% in 2015. According to the survey, respondents reported that the average proportion of their wealth invested in cash and bank deposits had increased to roughly 27% this year, up from 24% last year and 17% in 2015. Conversely, the amount of wealth invested in real estate investments fell to 15% this year, down from 24% last year and 30% in 2015. Globally, 42% of respondents said that they were being more cautious about making new investment decisions and were looking for less risk, while 20% said they had reduced or stopped global investment activities.